Okay, so as most of you may be aware, as of November, sort of early November, late October last year, we started to see the crypto market really sell off quite aggressively. And I think there's a number of reasons that we can attribute to that. Yeah, I'll jump into that. And again, listen, this is my point of view. Other analysts may have differing points of views. But in general, this is how I kind of see the landscape at the moment, and why we've seen such a sharp sell-off. So firstly, without looking into any detail into the crypto market itself, let's take a broader look at global macro and try and understand and put everything into context to see what is going on. And I think right now, all markets are very uncertain. The global economy is contracting. The USA is in a technical recession. They aren't very keen on admitting that they're in a full-on recession. They like to refer to it as a technical recession, which is 2 consecutive quarters of negative GDP growth. So the US is in a technical recession. Most other nations are following suit. There's problems in China, especially with regard to the real estate sector. And then I think 2 of the major themes right now that we are seeing is we are seeing the negative effects of COVID response around the world, particularly lockdowns. And we are seeing the effects of central bank response to COVID as well. So first and foremost, the lockdown response, I don't think anyone was under the illusion that that would be good for the economy or good for business anywhere in the world. It's resulted in a major slowdown in supply and demand across borders. We're seeing major supply chain challenges in various commodity sectors. And I think initially where we didn't see those effects and the economy wasn't suffering so much, as there almost always is a lag with these things, now we are starting to see that contraction and that slowdown in the economy due to the global response to COVID. Secondly, how did central banks respond to it? They responded with a very aggressive inflationary monetary response. So where the Fed and many other central banks around the world, they decided to print a lot of money to ease the issues faced with lockdowns and ease cash flow issues. And again, at the time, it didn't respond or didn't materialize in CPI. So what we saw was vast monetary inflation. And there's always a lag between that monetary inflation, which then trickles into goods and services, and then ultimately results in consumer price inflation, which I think, again, now we are seeing occur throughout the globe, particularly in the States, which is printing record inflation numbers, highest they've seen in 30 or 40 years even. Their latest print was 8.1%, if I'm not mistaken. The UK printed double-digit inflation CPI numbers. And of course, locally, we are feeling it as well. Now, the other major global event, which I believe has been affecting markets, is the Russia-Ukraine conflict. And essentially what has happened there is it's just put even more pressure on supply chains and even more pressure on the price of crucial commodities. Ukraine being one of the largest producers of grain and wheat, and Russia being a major supplier of gas and energy to various energy markets. And because of that, now that constraint in supply, that now is also resulting in significant price increases in those commodities. So putting all of that together, the economy is under a lot of strain. People are very uncertain. All that uncertainty leads to a risk-off sentiment where investors are not very forthcoming and aren't too keen to seek out yield-seeking investments and risk-seeking investments. So they become very conservative. They look to pull investments out and put them into what's perceived as safe holding. So they would prefer to hold in cash, treasury bills, bonds, etc. And what you tend to then see is that any assets which are perceived as risky bear the brunt of that contraction and that drawdown in investment. So what do the numbers say? Again, before we move in directly into the crypto markets, these macro events are having an effect on all markets and all markets which are perceived to be high risk. So if we look at stock markets and we look at the Dow Jones is going through its worst start to a year since 1962. And again, these stocks are very well established global brands that are instantly recognized: Nike, JP Morgan, Walt Disney, etc. They have drawn down by over 25% each in 2022. So we are seeing stocks suffering. If we move on and take a look at the NASDAQ, NASDAQ has been one of the best performing indices over the last couple of decades, as they have the FANG stocks listed on them. So some of the biggest companies in the world, we see Apple, Microsoft, Amazon, Tesla, again, globally recognizable brands, powerhouse companies. And as a result of the macro conditions, even these companies are suffering significant downturn. Year to date, Apple, you can see down 12%, Amazon 21%, Tesla down a quarter almost this year. So that risk-off sentiment is prevalent across all markets. So we are seeing many major assets suffering the brunt of that sentiment. Now, taking a look at the crypto markets, we see that the drawdown has been more significant than it has been in the stock markets. So we see an average of around 50% drawdown in some of the major crypto assets. And again, to me, this is not surprising. It's not surprising for two major reasons. Historically, looking at the asset class, it's gone through several boom and bust periods. And those bust periods, typically, we see a drawdown of 75 to 85% across the entire market before a new base is found, before new demand is given time to enter the market and have an effect on those prices and start to move those prices back in an upwards direction. So that's first and foremost, historically speaking, what we've seen with crypto assets. And then secondly, the asset class itself is only 13 years old. It's extremely new. It's not very well understood by the market. And as such, a 2 to 3 times risk premium to be put on these assets would make logical sense to me. So the fact that crypto assets have drawn down more than double what we've seen in the stock markets, again, this would make sense to me. Number one, because of the inherent risk in the asset class, and number two, because of the perceived risk and the lack of education understanding that is currently in the market. But as that improves, as investors become better educated and understand how to interact with these assets, I think over time it will fall more in line and act less and less volatile, but definitely not in the short term. I think that is still something that's 5 to 10 years away before the volatility starts to dampen. But as of now, from my perspective, I think these numbers are to be expected and is nothing out of the ordinary when we're discussing digital assets. Now, looking at the market as a whole, again, at the peak last year, end of October, early November, we saw the entire market reach a valuation of just over $3 trillion at its peak. And then since then, it's been about 10, 11 months now since that peak. We're now hovering around the $1 trillion valuation mark across the entire market cap. As of this morning, I saw it just dipped back under $1 trillion. So quite a significant drawdown, quite a significant correction. And again, something that I would have expected. Looking at sort of more sort of drilling down and looking at other contaminants and reasons why there's been a significant drawdown. The market itself was extremely highly levered coming into the end of last year. That was fueled by the run-up, and again a bit of a frenzy, people dying to get in, thinking it's an up-only market. As a result, people took on extreme amounts of leverages, and not only individuals, many established companies like BlockFi offering yield products, major hedge funds like Three Arrows Capital, trading and lending platform like Celsius, which has now gone into liquidation and frozen depositors' funds. So the market didn't do itself any favors. It levered itself way too far, and as soon as the prices stopped going up and that squeeze hit, then a lot of companies found themselves caught with their pants down and actually short of assets to cover their short-term liabilities. And again, that flush out is good. We need to flush out all the poorly performing companies and let the companies that are responsible and that are utilizing assets in a responsible manner, those ultimately will come out as the winners and the sustainable products that will survive. So again, while from a price point of view and a valuation point of view, things aren't looking so great at the moment, I think long-term, all of these events are healthy for the markets. All right, so that kind of sheds a bit of light as to why we've seen such a significant drawdown over the last 10 months, coming up to a year almost. So now I want to move on and I want to look at what we are seeing in the market outside of simply the price action. Many of the fundamentals haven't changed and are improving. And in terms of adoption and usage, all those metrics are looking very, very positive and again, pointing to long-term growth and long-term sustainability. Okay, so first and foremost, we take a look at a graph which is showing revenue generated on blockchain protocols. Okay, so most of you might recognize the number one over there, Ethereum, the largest at 2.7 billion, and then a range of other protocols that have come onto the market in the last 3 to 5 years. So what does this chart tell us? It tells us that there is a plethora of innovation and competition that is emerging in this market. And both of those are very good things. Not all of these protocols are going to survive. Not all of these protocols are useful and valuable. But the experimentation and innovation that's taking place, ultimately the market will sift out what is valuable and what is not valuable. So this is very, very healthy. If we looked at a similar chart, maybe 3 years or even 5 years ago, there would be a fraction of the number of protocols that are out there. And the amount of revenue that these protocols are processing, again, would probably be a 10th or even a 50th of the size that we are seeing going through these protocols today. So in terms of revenue and transactional value, the trend is very much moving upwards and moving upwards rather rapidly. In terms of the innovation that we are seeing on these protocols, where typically most investors are probably only aware of Bitcoin and Ethereum, maybe Ripple, where typically the foremost use case of those blockchains is simply value transfer or usage as money. What we are seeing emerging as a major trend is protocols that are looking to add more complex applications as a function of their network. So something like smart contract applications where people can enter into financial contracts without the need of an intermediary. NFTs, again, I'm still quite skeptical on the use case of NFTs, but they were very popular during the run-up last year, and it remains to be seen whether any of that is sustainable. And then we're seeing major development in the Web3 space. I won't touch into too much technical detail about what all of that means, but these are the sectors where we're seeing significant growth and innovation in the market. Okay, now moving on and looking at a rather basic Bitcoin metric. So this chart is tracking the number of unique addresses that exist in Bitcoin. And we can see it's a very clear trend upwards and to the right. We are just short of 100 million unique addresses on the Bitcoin blockchain itself. Now, this doesn't represent unique users or individuals, as one individual can have multiple addresses, but it is a very clear indication of increased usage and ultimately increased adoption by individuals and by the global market. And yeah, I fully expect this graph to continue on that gradient, if not an even steeper gradient in the years to come. So a pretty clear indication of increasing and growing adoption. Okay, now a similar chart, but this time looking at the Ethereum chain specifically. This chart is showing us the number of transactions that are processed on the Ethereum network each week. And again, in the span of around about 5 to 6 years, we can see from something pretty insignificant and close to zero, and progressing through various boom and bust cycles, we can see again that the trend here is very clearly up and to the right. And as these networks scale and as they become more useful and easier to use for the layperson, we expect to see greater and greater usage and greater adoption continuing throughout time. And again, if we were seeing declining prices and declining valuations along with declining usage, I think that would be quite a significant red flag. But the fact that we continue to see the fundamentals holding strong and adoption continuing to increase says that this is a very valuable technology. And as people are gaining access and understanding how to use it and finding value from that usage, we should expect to continue to see that. And in the short term, fundamentals being divorced from the actual valuations and price action in the market, again, that is a very human thing, and we see that in almost every market. Markets in the short term are emotional and will overreact and will correct significantly. And again, that can be disconnected for a period of time from the actual development and fundamentals that are taking place in the market. So from an adoption point of view, we can still be confident and see that these technologies and networks carry a significant amount of value, and we would expect that to continue to grow as time goes on. Okay, now a global snapshot of what the current estimates of crypto users are, or early adopters of these networks. And looking regionally, we see we're in the tens of millions on most continents when we look at, or when we think about daily active users. And again, this is a very good metric. It says to us in 13 years, there's been a tremendous amount of adoption, and that adoption is increasing rapidly. But at the same time, it says to us that it is still very, very early in the adoption cycle of these technologies. So 300 million active users worldwide, divided by a population of 8 billion. You can see it's still a very, very small percentage of the globe that is actually using these networks and trading in these assets. So that says that it's early days. I would put us in the early majority stage of an S-curve adoption graph, which means that there's still significant upside for people who see value in this technology and people who believe that it will ultimately be adopted on a global scale and become a normal everyday function of our economic lives. And I think a good analogy is to try and imagine the world before cell phones or before the internet. And the truth is, right now, we can't imagine that because we are so dependent on these technologies. And my belief is that ultimately, cryptocurrencies will be viewed in the same manner, where it will be part of day-to-day life. And the next generation particularly will not be able to imagine a world where these assets didn't exist. Now, if we zoom in slightly and we look at a country by country adoption and see how prevalent it is across different jurisdictions, we see some countries are slightly slower on the uptake, some are slightly faster. And again, at the high end there, we see Brazil, Indonesia, UAE undergoing quite rapid adoption. So close to 50% of the population there being exposed and using crypto assets. South Africa ranks pretty high there as well, and Nigeria at almost a quarter of the population. And I think one of the takeaways from here is that people come to the space for two reasons. First and foremost is out of need. So in developing countries where their financial infrastructure and their banking infrastructure may not be as accessible or as sophisticated as it is in the first world, people are using crypto networks to transact out of necessity. So for example, migrant workers who need to send money back to their families, they either have to pay exorbitant fees when using services like MoneyGram, or any of those other remittance services that are well known. They now have the option to send cryptocurrency to their families, which is a fraction of the cost, and they can execute that almost instantly. There's no red tape, there's no long sign-up process, they can't be denied a service on arbitrary grounds. So they now have an alternative payment network that exists outside of banks and major financial institutions. So that is the first point that attracts people to actually using these networks, is out of a financial need to use them. Then the second major use case is speculative and as an investment, whether that investment be short-term or long-term. And again, predominantly, we see those flows coming from more developed economies and more developed countries. And again, we can use ourselves as an example, or we can use investors in the States or Europe as an example, where we have more reliable banking networks, and we have access to make swift payments across borders. We can make instant local payments. We have access to financial services, whether we need, whether it's loans or overdrafts or insurance. Our economy is quite robust and pretty well developed. So for us, when we look at cryptocurrencies, we come to it mostly from the point of view that it may be a valuable investment, because we believe adoption will continue and we believe that need will always be there. We can see that in the long term, if the value appreciates, then there's an opportunity from an investment point of view to including these assets into a traditional investment portfolio. So again, the two main drivers of adoption, need and greed. And I think that will never change. Okay, now the other aspect to adoption. So it's not simply individuals which are using these networks and transacting on these networks. We're starting to see major adoption across businesses throughout the world. And I think, again, this was a logical next step, where the debate 5 years ago was whether or not these assets were going to disappear completely and go to zero and never be used again, or whether governments were going to shut them down. I think right now that is no longer a debate and a discussion. It's pretty clear that cryptocurrencies are here to stay. And as a result, we are seeing major businesses around the world actually adopt these cryptocurrencies and add the capability to actually transact and utilize cryptocurrencies in their day-to-day business. And again, just to pull out a few examples. And again, Visa, which could be seen as a direct competitor to cryptocurrencies, one of the biggest payment providers in the world for fiat currencies, now allows its customers or its users to make Bitcoin purchases using their debit cards. And this now gives access to owners of crypto. It gives them access to over 70 million merchants across the globe, basically making it as useful as your Rand account or your dollar account. And again, that was one of the criticisms often leveled against cryptocurrencies, that where can you actually use them? Where can you actually go and buy goods and services? And as it gets integrated into the traditional financial system, that just becomes easier and easier. And that access essentially gives you access to anything that your traditional debit card historically does. In terms of online payments, again, and this is not really a new development, this has been around for a long time. Almost every online merchant now allows you to check out and pay with Bitcoin or cryptocurrencies. And again, it's very simple because it cuts out the middleman, it cuts out the payment processor. So it's cheaper for the vendor, it's cheaper for the customer, and it's more efficient. Settlement occurs in real time, as opposed to delayed settlement that happens on most payment networks. So there is a lot of efficiency to be gained, and there is a cost benefit for both merchants and customers. And again, as that trickles through the economy, it'll simply become easier for people to use and garner more and more value for the networks as a whole. Okay, so again, just zooming out and summarizing, across all the major adoption metrics, everything is still pointing up and to the right. So that is positive for the space. It means people are using it. It means these assets are becoming more convenient and easy to use for the layperson. And as that adoption grows, we're then seeing it spread to corporates and institutions. And ultimately, again, I think it'll become quite a ubiquitous thing to see cryptocurrencies being used day to day. Now, one of the major hindrances to that adoption has been regulation. And regulation around the world has been pretty slow. South African regulators have also been pretty slow to the party to come and offer clarity to the market. And it's especially prohibitive for institutions. Without the requisite regulations and guidelines, it's very difficult for institutions to actually invest into any new asset class. So what are the latest developments, and where do we see regulations going locally? So there has been a recent update. We are expecting explicit regulations to be introduced within the next 12 to 18 months. Cryptocurrency is going to be regulated as a financial asset, not as a currency. And as such, it's going to be brought under the umbrella of existing financial regulations, and where it requires specific guidance, there will obviously be legislation added to deal specifically with crypto assets. So the goal is ultimately to bring it into the mainstream, which broadly is good news. So the asset class is being accepted. It's going to be included into the umbrella of under the umbrella of financial assets, and ultimately it'll open the door for a flood of new investments, particularly from institutions, to flow into the market. Now, again, the framework for these regulations has been published. It was published by a group called IFWG, Intergovernmental FinTech Working Group. I do have their latest policy recommendations available. So for anyone who would like to take a deep dive and actually go through those recommendations, I'd be happy to share that PDF with anyone who's interested. Just drop me a note in the Q&A, or pop me an email at the end of this webinar, and I will share that along. But to summarize that and what has been proposed in these recommendations, from a Reserve Bank point of view, cryptocurrencies are going to be regarded as a financial product, and their main concern is to ensure that capital controls are not violated. So they will require reporting from any vendors and from individuals who trade in a private capacity. They will require them to disclose whether any capital has been expatriated or not. So from their point of view, they need to ensure that capital controls are not violated. And again, that's to be expected, and that's normal, because that applies to absolutely any financial instrument or any asset that has a significant monetary value. Then secondly, looking at SARs and considering a tax treatment. Tax treatment will depend on usage, again, as it does for any other intangible asset, which means it can be regarded as income, or gains can be taxed as income or capital gains in nature. And yes, again, that will depend on the specific usage. Depends on things like the intention at the time of entering the investment, time held on the investment, and certain other variables that will come into play and consideration when deciding on how your usage of crypto assets should be taxed. And again, I think that's pretty clear, and that's been the case for the last 5 or 6 years in any case. So not too confusing on the tax front. Then lastly, from an FSCA point of view, anyone offering and advising on crypto products will need to be classified as a CASP, or a crypto asset service provider. And ultimately, they will look to introduce accreditation and licensing that speaks specifically to the cryptocurrency asset class. So again, it'll be treated almost like any other financial product, but it'll have its own unique classification that regulates that specific market. And again, I think once all of this regulation actually comes through and gets implemented, it'll be a major positive for the market, because there will be no more uncertainty, and it will open the floodgates to a ton of new investment to enter the market. Okay, and then just to touch briefly from a global point of view and how regulations have been handled across different jurisdictions. In the States and in Europe, by and large, their treatment is the same as we have treated it. They're looking at it as a financial product and not so much as a currency. But we do have differing treatments in other jurisdictions. And most notably, I've pulled out El Salvador here and the Central African Republic. And those two nations are the first countries on earth to actually recognize Bitcoin as legal tender, and to fully legalize the use of cryptocurrencies within their market. So they've made it legal tender, which has interesting implications to other jurisdictions and other countries, because that classification may affect how other nations have to treat it. Because if they are forced to recognize it as a foreign currency, then treatment may change. And again, these experiments are quite early on. I think it's been just short of or just over a year for El Salvador recognizing Bitcoin as legal tender, and around about 6 months for Central African Republic. And again, I think that kind of trend is what we'll expect to see, where developing nations with far weaker national currencies will welcome the adoption and usage of cryptocurrencies, because it allows them to be more competitive on a global scale. And it gives them a unit of account to store value that is not dependent on a central bank or a national economy that is weaker than most others. So it'll be interesting to see how those experiments play out, and whether or not it spreads to other countries who see value in adopting and taking a more positive stance towards the usage of cryptocurrencies in their economy. Again, now we looked at adoption by individuals. We are seeing increasing adoption throughout the business world as well, and the corporate world. And I think the last piece to the adoption puzzle is with institutions, and particularly banking and financial institutions. And the major hindrance to this piece of the puzzle is regulation. So as that regulation becomes more clear, and as it trickles through the global economy, and these institutions know how they are required to deal with it, then it becomes much easier for them to offer products to their clients, and to be able to transact on these networks just like any other individual user. And slowly but surely, we are seeing this adoption increase. So all of the big brands and big names that you're seeing on the slide, so Barclays, Morgan Stanley, UBS, Goldman Sachs, etc. Over the last sort of year or so, perhaps a year or two, they have all invested R&D into developing crypto products, and many of them are already offering those products to their high net worth clients, and in some cases to all of their clients across the entire user base. And again, the trend as we get more and more clarity will simply be that every financial institution is able to use and offer products and services that are related directly to cryptocurrencies and crypto products. Okay, now I want to move on and just talk about stablecoins briefly. Stablecoins are a very interesting part of the crypto ecosystem. From an investment point of view, they don't offer great exposure to large gains and large growth, because as you can tell from the name, they are designed to be stable and to be backed one-to-one by another currency. And in most cases, of course, the most popular type of stablecoin is a USD stablecoin. So a token that represents exactly $1. Now, the stablecoins themselves represent more than 15% of the entire crypto market cap. So as a sector, they are the second largest after Bitcoin and Ethereum. And I think this is very, very important for a number of reasons. So number one, what it's saying is that individuals around the world are demanding a token or a monetary good where they can store value that exists outside of their legal tender or their mandated national currency. So for the developing world and the third world that doesn't really have access to dollars, stablecoins now all of a sudden give them very easy and very direct access to holding dollars, which in many cases they view as a superior currency to their own. And then secondly, what it gives them access to is it enables them to transact on a global network. So without having to go through an intermediary, they can now transact directly with the trading partner or directly with other individuals. And all they need is an internet connection and a crypto wallet that can hold these tokens. And the fact that we are seeing such rapid adoption of this, again, I think is pointing towards that trend continuing and more people using stablecoins and more volatile crypto assets. Now, there's a plethora of stablecoins that are out in the market. So we've got Binance USD, which is the BUSD. There you can see as the first asset-backed stablecoin. We have USDC, which is the first fully regulated stablecoin, and Tether, which is USDT, which was the first stablecoin to be created and offered into the market. Now, these are known as asset-backed stablecoins, which means that the token is issued by a counterparty. So using USDC as an example, the company that operates that stablecoin is called Circle. And what they do is for every dollar deposited into their account, they will then issue a USDC token to that depositor, which then allows them to transact on that crypto network. Now, typically, these have been very reliable. To my knowledge, none of them have failed or gone to zero. But what's important to be understood is that it is reliant on the counterparty. So if Circle or Tether or any of these counterparties mismanages the dollars that have been deposited into their accounts, then it puts them at risk of losing that peg that they are sticking their token towards, and then holders of those stable coins will be exposed to that loss in value. But again, as I've mentioned, these tokens have historically been very reliable. Tether's market cap currently is sitting at, I think, between 60 and $70 billion. And they managed to process over $7 billion of redemptions within 24 hours. And that was during the Terra Luna collapse, which occurred late last year. And so that points towards them being very reliable and being pretty stable as it stands forth. I don't think most banking institutions that have been around for hundreds of years, if they suffered a bank run up to the value of $7 billion, we can speculate that a lot of them would not have survived that event either. So they've gone through a lot of strain and a lot of tests, and so far they've proved very reliable. Now, on the flip side of asset-backed stablecoins, we also have algorithmic stablecoins. Now, these stablecoins are not backed one-to-one by a dollar in the bank. They are backed by some basket of assets, and those assets may be real-world commodities, maybe fiat currencies, and maybe a combination of some type of crypto assets. And the reason it's algorithmic is because these issuers have developed an algorithm which is supposed to maintain the peg to whichever currency it's pegged to, and determine what the optimum bundle of assets should be held in order to maintain that peg. Now, I would be very skeptical of these algorithmic stablecoins, purely because they are still very experimental. And with the collapse of Terra Luna, which we saw occurring earlier in the year, you can see how risky they are. and how when there's a flaw in that algorithm, it can be taken advantage of and it can be attacked by hostile players in the market. And ultimately, holders of those stable coins will suffer and lose that value. So very important to be skeptical and risk averse if ever considering to interact with stable coins and hold those as part of any type of portfolio. Okay, now moving on to second last section of today's webinar. We're going to take a deeper look at storage and custody. So the growth of this market is fantastic and the opportunity there is great and for all to be seen. But if these assets can't be securely held and securely accessed, then ultimately they can't really hold any type of sustainable value, and it's not worth investors looking at and investing in this space. So luckily, we do have a 13-year history where we can look at what's gone wrong in the past, where people have been exposed and vulnerable to losing their investments, and we can learn from those mistakes and come up with the best scheme to custody our assets and ensure that it is safe and secure. So first and foremost, the risks that investors are exposed to when they invest in any type of asset are four main risks. So there's market risk. Of course, the price of an asset can go up and down. Then there is technical risk. So that is transacting, storing, and interacting with that asset. And also, and that includes estate planning and succession planning. How do you pass those assets on? Thirdly, there's regulatory risk. And fourthly, there's counterparty risk. Now, all of those risks need to be considered and taken into consideration when deciding how and where an investor wants to store their assets. And again, as I said, this applies to any asset, and particularly with crypto assets, these considerations are very, very important. Now, the options that investors currently have, they can use an exchange. They can use that exchange to buy and sell their assets, and at the same time, they can use it to custody their assets. Now, historically, this has been a very insecure way of storing assets. The number one reason for loss with crypto assets has been user error, but second to user error has been exchange hacks, where investors simply leave their assets on an exchange, and there's a vulnerability in their systems, and hackers take advantage of that. So that is extremely high risk and continues to be high risk to this day, even with all of the developments in the market. Second option is to store assets on what's known as a hardware wallet. So this is a specialized device, something like a USB device, which offers slightly better security, but again is reliant on the user to be able to understand and operate it themselves. Another type of storage is a paper wallet, which doesn't rely on any type of hardware, and is designed to be completely offline, as is obvious by the name, a paper wallet. But again, there are flaws and insecurities with that type of storage as well. And then lastly, we are seeing the emergence of regulated custodians that implement very sophisticated cryptographic techniques in order to ensure the safety of depositors' assets. And of course, being regulated, it removes the regulatory uncertainty and offers some sort of clarity on the regulatory front, so thus removing that risk. So these are the main options that exist for investors. And again, it depends on the individual and what type of risks they believe they need to mitigate. And that will inform their decision as to what the best type of storage is for them at that stage. Now, I've put those four types of storage onto a security convenience spectrum. And again, this will change depending on the individual and depending on how they assess the risk. But ultimately, what you want is something with the highest level of security and the most amount of convenience. And this depends on the type of investor, it depends on the size of their investment, how exposed they are to the asset class, whether they favor security and whether they favor convenience. I know a lot of people that have two types of storage. They have their large long-term storage, which they want to lock away forever and have, and obviously favor security over convenience. And then they have a day-to-day wallet, which may be on their cell phone, where they favor convenience over security because it's of a much lower value. So again, it depends on the individual. It depends on why they're investing and what their outlook is with these assets. And the spectrum may change. Different individuals may prefer one over the other. But in general, you want to be furthest or top right, as far top right as possible, have the most amount of security with the right amount of convenience and access. Okay, now again, just to touch on the type of technical risks that investors into cryptocurrencies are exposed to, because we do tend to suffer from recency bias in that we underestimate risks unless it's something that's happened very recently. I know a lot of people who simply dismiss the hacking risks as something that could only have happened, 5 or 6 years ago, and right now things are more secure, so they may think it's safe to leave assets on an exchange. But looking at this timeline and seeing how recent a lot of hacks and how prevalent these hacks are, I think it's important to understand that this risk is always something that exchanges are exposed to and always needs to be taken into account. And just to kind of zero in on two of these points, 7th of May 2019, Binance hacked for $40 million. Binance is the largest crypto exchange on earth. And as such, you would think they are one of the most secure, but it goes to show that there can always be errors in the internal procedures and the internal security. And hackers are constantly probing these exchanges for vulnerabilities because they know that if they find one, then they stand to score a big payday. So incidences of individuals being hacked are in fact extremely low when compared to incidences of exchanges being hacked. And that's pretty simple. It's because the honeypot with exchanges is much larger than it is with individuals. So we see even the largest, most successful exchange that we have is vulnerable to these exploits. And now, more recently, crypto.com, which is also a very, very fast-growing exchange, they were hacked as recently as 17th of Jan 2020 for $34 million. So again, if people who want to write these risks off as being insignificant, they may end up finding out the hard way that they need to actually seriously consider these risks. And the best course of action is most likely to remove their assets off of exchanges so that they aren't constantly exposed to these hacks. Okay, so again, when considering an investment into this space, how to store your crypto is a crucial consideration. And it depends on how the individual evaluates which risk they consider to be one that they are most exposed to. But putting together a comparison table such as this is a useful way to consider what the best scheme is for the storage of their assets. So all of these, custody can be a DIY solution. And again, for experienced and technically adept investors, there's nothing wrong with a DIY solution. But as I mentioned earlier, historically, individual error is the #1 cause of loss across the market and across crypto assets. So DIY should only be done by those that are 100% confident and 100% competent in what they are doing. So now for investors that would rather store their assets with someone else and trust someone else to handle that for them, they need to consider what is the best setup for themselves. So do they leave it with an exchange? And again, as discussed, that exposes them to a multitude of risks and exploits, which historically, again, has also resulted in a tremendous amount of loss. They can consider something like a paper wallet. And then lastly, they have the option of vetting regulated custodians. And there are a number of them in the global market that offer services. Not all of them are accessible to individuals. And locally, there aren't very, very many solutions. And this is something that Geltec is looking to offer to individuals, corporates, and institutions ultimately, that offers them a favorable solution, which is in line with regulations, and gives them the convenience that they are looking for. So a very important consideration when looking to enter the space and make an investment. So now, lastly, just to end off this webinar, I want to touch on what Geltec is doing and what we are offering. So firstly, we are offering basket investments. Our cryptocurrency basket is live and currently trading in the market. This was launched in September 2021. So we are almost a year old with our cryptocurrency basket. That is aimed at being a large cap basket where we try and incorporate the largest crypto assets and give investors exposure to the blockchains that we think are going to capture the bulk of the market. So that is very much size dependent. And we are busy working on a blockchain basket, which is looking to invest in maybe some of the lesser known blockchains and the more experimental blockchains, which may not be the largest right now, but we believe have medium to long-term value and will probably capture a lot of the adoption that is coming into the space. So that blockchain basket is still in development. We are in the final stages, and we'll hopefully have a product ready to launch by the end of this month. So from an investment point of view, we have those baskets. These are fully regulated products. Since we entered the crypto space, we treated it as a financial asset from day one. So voluntarily added all of the compliance and reporting as if it was a financial product already. So all of these products are fully compliant and fully regulated. Okay, and then our custody solution, so Geltec's off-exchange safety deposit box. And this is out there for the non-technical investor who would rather trust an expert to secure their assets as opposed to securing it themselves. And again, what we're trying to achieve with this is we're trying to achieve the optimum balance of security and convenience for the client, where the client doesn't want to do it themselves. They can deposit their assets with Geltec. Our base charge is 50 basis points per annum for the setup. And yeah, as I said, we try and offer the optimum amount of security and convenience to the client. Fully regulated, fully compliant, and particularly from an estate planning point of view, it means that those assets will be securely passed on to the estate, where in many cases investors don't think about that, and if a negative event happens, then no one knows how to actually recover those assets, and they tend to be lost forever. So please, if anyone is interested in getting more information on either of these products, do feel free to visit our website, www.geltec.co.za, and you can also contact me directly. There is my email address, andoni@geltec.co.za, and I'll be happy to respond to your questions and share any information that is relevant. So thank you very much for joining me today.